In this video, we will calculate the cost of capital for a company. To find this menu option, click on the word Research from the dashboard and Valuation from the submenu. Cost of capital is the first menu option. We can maximize space by clicking on the triple and double arrows as well. We will use Caterpillar with the symbol CAT as our test case. We will compare Caterpillar to the Dow Jones average for the last 5-year period. What we are doing is actually calculating the cost of capital in components, starting with the beta. The beta is used in the cost of equity, and each of these costs are a component of the WACC. In this case, the beta for Caterpillar is calculated out as 2.13 for the last 5-year period. The cost of equity is the real cost to a company for raising capital on the public markets. There are a number of rate premiums that are built into the cost of equity. We will accept these and run the cost of equity calculation. We see that we can do a build-up method or a capital asset pricing model method, which we will use in these calculations. The cost of debt is the borrowing cost for the company, and essentially it's the interest paid divided by the total debt, but it is an after-tax cost. In the case of Caterpillar, the after-tax cost of debt for the last 3 years has been 2.3. If the company had preferred shares, the dividends paid divided by the total preferred stock outstanding will give us a cost of the dividends. In this case, there are none for Caterpillar. Finally, the WACC tab pulls together all of this information. We use the market value of the equity, the book value of the debt to determine the percentages of each of these components in the capital structure of the firm. We take the costs that we've generated from the previous tabs, multiplied by the weighted averages to come up with our weighted average cost of capital. We can then save this weighted average cost of capital for further use.